So hello my colleagues, and I do hope everyone is well. So I want to pick up here on example 2.2 where we left off on the other part. So this is an example on the how a depreciation affects cash flow. And so if you read this example, suppose Global had an additional $1 million depreciation expense. If the tax rate on a pre-tax income is 26%, what would be the impact of this expense on Global earnings? How would it impact Global's cash at the end of the balance? So depreciation, and it's important to know, depreciation is looked at as an operating expense. Global's operating income, EBIT, and pre-tax income would fall by $1 million, right? So the decrease in pre-tax income reduces Global's tax bill by $260,000 here, right? I think there's a mistake here, right? So it says 26 by 26. It should only be one here, right? Therefore, net income would fall by $740,000. All right, so in the statement of cash flows, net income would fall by $0.74 million, but we would add back to the additional depreciation of $1 million because it's not a cash expense. Thus, cash from operating activities would be minus 0.74 plus 1 equal 0.26 million. Thus, Global's cash balance at the end of the year would increase by 0.26 million, the amount of the tax savings that resulted from the original additional depreciation expense. So basically, you're just adding the depreciation back on the cash flow statement. Okay. All right. So let's. I hope this video plays, but let's give it a shot here.
The impact of depreciation on cash flow. In this problem, we're supposing that Global has an additional $1 million in depreciation expense in 2013. We're going to assume that the tax rate on pre-tax income is 26%, and we want to know how is this going to impact their earnings and how will it impact their cash at the end of the year. Well, if you look at their income statement, you see that depreciation is in fact an operating expense here. So this part's going to change. In fact, it'll be negative 2.2 instead of being negative 1.2 because of the additional million. That of course means that operating income will now be $1 million less. It'll be 9.4 instead of 10.4. Interest, income, and expense will stay the same at negative 7.7. But pre-tax income will be $1 million less, 1.7, because of the depreciation expense. So since we have less income, we're going to pay less in taxes. Remember, taxes here are 26%. So instead of it being $700,000 in taxes, it's going to be less because we have $1 million less in income. We pay 26 on the dollar in taxes on our income. So we should have $260,000 less in taxes because of the $1 million lower in income. And so that means that this is going to be negative $440,000, which is $260,000 less than $700,000. So we'll put that as 0.44 million. And so our net income, instead of being 2 million, it's going to be less than it was before, but not less by the full $1 million because we pay less in taxes as well. So it's going to be 1.7 minus 0.44 or 1.26. So we basically have $1 million expense that lowers our income, but because we don't have to pay taxes as much in taxes because of the 26% in taxes, our income isn't lower by $1 million, it's lower by $740,000, which keeps the $260,000 in. So now the question is, what's going to happen to our cash? Now remember, the thing about depreciation is that it's not an actual cash outflow. So it's a quasi-expense in the sense that it's an expense for computing taxable income, but there's no cash outflow associated with it. The cash outflow occurred back when we actually bought the equipment that we're depreciating. Now, if it weren't for the tax effect, we would just ignore it for cash purposes. Since it's not a cash outflow, we'd love to ignore it. But the thing is, it affects taxes, which are very much cash outflows, so it is going to matter from a cash flow standpoint. So if we go to the statement of cash flows, what's going to happen here? Well, our net income is not 2 anymore. Now it's 1.26. But our depreciation and amortization is not 1.2, it's 2.2. These all stay the same, negative 5.3, 2.7, negative 1.0. So the change is coming from up here, and the cash from operating activities, instead of being negative 0.4, will actually be, so that would be negative 400,000. It'll actually be 260,000 greater, so it'll only be negative 140,000, or 0.14 million. So why is that? Well, think about it this way. The $1 million in depreciation reduced our taxes by 260,000, but it's not an actual cash outflow, so we didn't actually spend $1 million in cash. So the only effect the depreciation had on our cash flows is that it saved us $260,000 in taxes. That's why our cash from operating activities, instead of being a $400,000 loss, is now only a $140,000 loss. Going down and figuring out the final effect on cash at the end of the year, these all stay the same. They're not affected by the depreciation, so this all stays the same. And the only thing is then that the $260,000 in savings will flow directly through to the change in cash and cash equivalents. So instead of being a gain of 2.7 million, it's now going to be a gain of 2.96 million. That's the 2.7 million plus the $260,000 that we saved in taxes. So the key here is to note that depreciation matters because it's a deductible expense. It's an operating expense, so it reduces your taxable income, which means it reduces your taxes. Once you reduce your taxes, that means that it's going to change your cash flows. And so you can see the effect through the cash flows.
All right, so I hope everybody found that interesting. All right, so I want to talk about the statement of stockholders' equity. And this breaks down the stockholders' equity computed on the balance sheet into the amount that came from issuing shares, par value plus paid-in capital, versus retained earnings. All right, so the book value of stockholders' equity is not a useful assessment for financial purposes, right? Because financial managers use the statement of stockholders' equity infrequently, so we will skip the computational details. We can, however, so we determine the change in stockholders' equity using information from the firm's other financial statements. So this is what I was talking about. This is like the statement of retained earnings, right? So this is basically telling you what the change in stockholders' equity is, and in a lot of books they use this as a fourth statement, and they call this the statement of retained earnings. Okay, so that's basically what this is. And if you pick up another book or even Google it, you'll find a statement of retained earnings in a lot of books. All right. All right. So the management discussion analysis basically in the beginning of the financial statements, and I just want to tell you that all that does is give you the recent year, providing a background on the company and anything that occurred. And I read that a lot too. I read these short blurbs, okay? So, and again, there's a term called off-balance sheet transactions, which are transactions or arrangements that can have a material impact on the firm's future performance, yet do not appear on the balance sheet. So this is kind of, an important statement, right? So this is an important statement. All right, and then you'll find notes to financial statements, all right? So they'll put like little notes on the bottom about what's been going on, details of acquisitions, spin-offs, leases, taxes, etc. All right, so anyway, I don't know. This is just a little thing about categories of sales and stuff. All right, so let's go over some of these ratios now. All right, so there's a bunch, and this is what tells you the health of the company, right? And it compares the firm with itself by analyzing how it has changed over time, and it compares the firm to other similar firms using a common set of financial ratios. So we're going to look at different ratios, right? Profitability, liquidity, working capital, coverage, interest coverage, valuation, and operating returns. All right, so the profitability ratios, we'll start here, is gross margin, and this is easy, right? You take this, your gross profit margin, it comes off, it's your gross profit off the income statement divided by sales. Now your job is to determine where these come from, just by these terms, okay? All right, and then the operating profit margin is the operating income over sales. All right, so those are the first two. Again, this is income statement, right? And sometimes you'll see them do a computation on EBIT margin, all right? And we'll call that EBIT margin. So again, and here's how you can see how your company is for 5 U.S. airlines, right? The EBIT margins for 5 U.S. airlines here, and different colors correspond to different airlines, right? All right, so the next one is a net profit margin here. And now this is, again, net income on the bottom over sales, all right? Again, this is all income statement, right? And this shows the dollar in revenues from revenues that's available to equity holders, stockholders, okay? Anyway, all right, so those are the three important ratios with regard to profitability, right? And the math is trivial. It's just that where to find these items. All right, now liquidity ratios. Basically, they're going to tell you how liquid the company is, right? This is telling you liquidity ratios, and the current ratio is the first one. That's current assets over current liabilities off the balance sheet. Again, please go by these numbers and look where to find them, because they use this global company in throughout the chapter. Okay, and then there's the quick ratio, and the quick ratio will basically include the inventory. All right. So the quick ratio is the ratio of current assets other than inventory to current liabilities. So they basically subtract off the inventory, right? All right, and then there's a thing called cash ratio, which just looks at the cash on the balance sheet. All right, so there's a nice example here you can go over, right? Calculating Global's quick ratio and cash ratio here. Just plug in the numbers and make sure you understand where they come from. That's all.